All right, let's unpack this. Today, we are embarking on a deep dive into a topic that's, well, absolutely foundational for any serious trader out there: backtesting, and specifically how it's currently undergoing this really fascinating transformation. We're going to explore how even just a foundational understanding of code, or maybe just being able to read it, combined with the remarkable power of AI, can truly supercharge your strategy development and save you countless hours. We're drawing key insights from a piece called The Backtester's Edge: How Code and AI Transform Your Strategy Game. It's a really insightful read, I think, for any trader looking for that analytical advantage.
Yeah, what's fascinating about this approach is how it positions backtesting, not just as like a necessary chore, but as the essential microscope every trader really needs in their toolkit. It highlights a critical shift, almost revolutionary, I'd say, moving from those often exhaustive and frankly error-prone manual methods
Okay.
to far more advanced, efficient techniques. It's really pushing the boundaries of what's possible for, rigorous strategy validation. It's about moving from just intuition to actual evidence.
I agree completely. And look, when we talk about manual backtesting, it's not all bad, right? There are definite psychological benefits. You stay mentally engaged, definitely. You often intuitively discover sort of nuanced market behavior just by staring at charts for hours on end. And you build this really deep, almost personal connection with price action. It feels like you're truly understanding the market. But as we all know, there's a pretty significant downside. It's just inherently inefficient
Yeah.
and riddled with potential pitfalls.
Precisely. The limitations of manual backtesting become, well, glaringly obvious very quickly for any active trader. I mean, you simply cannot test more than maybe a few months of intraday data, say 5-minute charts, without hitting significant cognitive fatigue and just sheer exhaustion from dragging charts and meticulously noting every single entry and exit. It's painstaking. This process makes it incredibly difficult to quickly change a parameter, like, say, a moving average length, and then retest it across a meaningful data set. Forget about it. And even worse, once you've seen the outcome of a trade scrolling forward, you're so prone to cognitive biases. Things like hindsight bias or confirmation bias, which just undermine all objectivity. You start to see what you want to see, basically. Fundamentally, manual backtesting becomes a bottleneck for genuine strategy discovery and, importantly, unbiased evaluation.
Okay, so given those obvious limitations, what's the typical next step most traders try? Do they jump straight into coding, or is there like a common intermediate stage, something offering a bit more structure?
That's a great question, and you've kind of hit on it. Many traders naturally gravitate towards spreadsheets. They see it as an upgrade from purely manual chart work. And look, it is progress up to a point. Spreadsheets let you apply basic formulas, calculate profits, maybe simulate some basic parameter tweaks, like messing around with different moving average lengths, for instance. And you can analyze foundational stats, your win rate, expectancy, stuff like that. It feels like you're bringing a bit more analytical rigor to your process, which is good.
Yes, for simple calculations, spreadsheets can definitely be helpful, but I've personally run into their limits pretty fast. Where do they really start to, fall apart for a trader?
They start to crumble almost immediately when your strategy becomes even slightly complex. We're talking about strategies with multiple intricate conditions, maybe needing price to be above a moving average while RSI is below a certain level and volume is picking up significantly. Or if you have more sophisticated position sizing rules based on volatility, maybe, or specific session filters where trades are only allowed during certain hours. As soon as you add that layer of dynamic detail, that interaction between different rules, spreadsheets just quickly become cumbersome. They get error prone and ultimately pretty unreliable. Trying to manage trade sequences and varying position sizes in a spreadsheet, it can feel like building a skyscraper with Legos, honestly.
Okay, so here's where it gets really interesting, because a crucial insight from the Backtester's Edge piece is this. You don't actually need to write great code yourself, but you absolutely must be able to read and verify it. Why is that specific distinction so revolutionary for traders right now?
Well, it's revolutionary because it dramatically lowers the barrier to entry for advanced backtesting. It really does. It means the focus shifts. It's less about becoming some kind of syntax wizard, an expert programmer, and more about cultivating a critical eye, a strategic understanding of logic. With AI tools like ChatGPT readily available now, the heavy lifting of actually generating the code, that can be handled for you. I mean, AI can literally generate complete backtesting scripts in Python. Your job isn't to be a coding virtuoso anymore, but rather to be a diligent editor, a smart strategist. It sort of democratizes access to these incredibly powerful analytical tools, it lets you focus on the trading logic itself rather than getting bogged down in the programming minutia.
Right, that's the dynamic we're seeing now. So how should a trader think about working with an AI like ChatGPT in this context? Is it just magic?
Huh, not quite magic. Think of AI more like an incredibly eager, super fast freelancer. That's a good analogy. It works incredibly quickly, right? Processing information, generating code in seconds. But just like any freelance work, you must review everything it produces carefully, really carefully, before you trust it, especially with something as critical as your trading capital on the line. The article strongly points out, and it's true, that AI frequently makes logical errors, or it introduces subtle misunderstandings into the code. So your key understanding needs to be the basics. How are entries defined within that code? How are exits triggered? And crucially, how is profit and loss ultimately calculated? If you can grasp these fundamentals, you're already light years ahead of someone just doing manual backtesting.
That makes so much sense. Okay, let's walk through a practical workflow example then. Something a trader listening could actually do, maybe even right now. Using ChatGPT for, say, a simple moving average crossover strategy on, I don't know, 5-minute NASDAQ data. What would that process look like step by step?
Okay, sure. So the first step is getting your data. That's key. This could be from a service like Polygon.io or First Rate, or even publicly available sources like Yahoo Finance. Or you could just export data from a charting platform you use, like TradingView, into a CSV file that's comma-separated values. You'd want to format this raw data, so it includes open, high, low, close, and volume OHLCV for each bar. Pretty standard stuff. Once you have your data as a clean CSV, you just upload it directly to ChatGPT.
And then you just tell it what you want.
Pretty much, yeah. You then systematically prompt ChatGPT. Tell it what to do. For example, you might start by asking it to add a 20-period simple moving average column and a 50-period SMA column to this data. Nice and clear. Then maybe mark all long signals where the 20 SMA crosses above the 50 SMA and all short signals where the 20 SMA crosses below the 50 SMA. After that, simulate entries and exits for these signals with a fixed 10-tick stop loss SL and a 20-tick take profit TP. You'd then ask it to show a clear table of all trades executed, including entry exit prices, P&L, and maybe duration. And finally, plot a basic equity curve based on these simulated trades so you can see the performance visually. Now, your job, and this is crucial, can't stress this enough, is to sanity check every single step. Does that MA crossover actually align with what you see on your chart? Are trades being taken exactly as you expected? Are the P&L calculations correct? You have to check. If not, you debug it. Ask ChatGPT to explain its logic or tell it to fix specific issues you found. Once you're satisfied with the logic and the results look right, then you ask ChatGPT to generate the complete Python code for your strategy. You can then download that code, run it locally on your own machine, tweak it, refine it further. You're in control.
Wow, okay. So this basic understanding of just prompting AI and importantly, sanity checking its output, that really becomes your gateway to beyond basics strategy optimization. Sounds like where the real edge is built, right?
It absolutely is. That's where the power lies. With just a few additional lines of Python, or by asking AI for specific modifications, you can move from testing just one scenario to true systematic experimentation. Real science. You can easily loop through different parameters. For example, testing various moving average values, maybe 10, 20, 30, and so on for both moving averages in our example. You can then run these backtests across years of data, not just a few months. This allows for much more robust validation, and the best part is you can automatically log the key metrics, the win rate, the drawdown, the profit factor for each and every parameter setting, without manual tracking. This fundamentally shifts your trading approach. You move from merely guessing or, hoping a strategy works, to systematically experimenting and gathering objective evidence about your edge. It's moving from just art or gut feel to applied science.
Now, I know what many traders listening might be thinking right now, but isn't programming hard? I'm a trader, not a coder. And yeah, it can be, especially complex programming. I get that. But the backtester's edge makes this really powerful counterpoint. Trading is harder. Think about it. You've already invested countless hours staring at charts, devouring strategy guides, tweaking your stop losses again and again, learning how to simply run a Python file, read a few lines of code when you need to, and maybe tweak some parameters. That's a one-time upfront cost. A learning curve, sure. But it's a cost that, when you compare it to the years you might otherwise spend manually testing or just staring at screens without clear evidence, it will save you months, maybe even years, in your trading journey. We're not talking about becoming a professional software engineer here. Not at all. We're talking about like amateur programming. Foundational skills, stuff that's readily available in introductory courses or online tutorials today, high school level almost. Getting comfortable with reading simple logic, just understanding the step-by-step instructions, understanding how loops allow you to test parameters efficiently, and how conditionals let you define those if-then training rules. That is truly all you need to get started. These are the core building blocks for, well, virtually any strategy you'd want to automate or at least verify properly.
That said, a word of caution is absolutely necessary here. AI is not magic. You can't just blindly trust it. Tools like ChatGPT can write your strategy code with incredible speed, yeah, but they have distinct limitations. We have to be aware of them. For instance, they can hallucinate, which means they might generate incorrect information or logical flows that just don't make sense in a trading context. They can also forget context, especially in long chat sessions, which can lead to inconsistent outputs later on. And they might silently tweak logic when you ask for parameter changes without explicitly telling you about the underlying modification they made, which can be dangerous. It's like having an incredibly fast intern who sometimes gets the details wrong and needs constant supervision. This is precisely why the ability to verify code, even if you didn't write it yourself, is so essential. And this verification capability often goes hand in hand with being able to understand the core logic of programming, even at a basic level. It helps you spot those subtle errors.
Okay, so moving from manual to algorithmic backtesting. It isn't about eliminating challenges entirely. It sounds like it's more about trading one set of problems for a new, maybe more interesting set of challenges. It's an evolution, right? Not an eradication of complexity. So what are some of those new challenges traders face?
Exactly. Well put. When you shift to code-based backtesting, you encounter different hurdles, but often, I think, more productive ones. First, there's strategy complexity. Let's be real, some strategies are genuinely hard to code. Imagine trying to programmatically define the nuances of, say, a human-drawn trend line that adapts with market context, or a supply-demand zone that relies on subtle visual cues and, let's face it, subjective interpretation of price action. These often require more advanced techniques, computational geometry, maybe even machine learning, which can indeed be more complex than, say, programming a simple game with very explicit rules. However, and this is the upside, wrestling with this coding complexity forces you to be incredibly precise about your strategy rules. You have to define them clearly. And that process, in turn, makes you a sharper, better informed trader, forces you to define your edge with mathematical clarity, which is invaluable. The second challenge is overextending on historical testing. This is a common trap. You might be tempted to validate your strategy across, 1 year, 3 years, 10, maybe even 20 years of data. And while broad testing sounds good, the danger here is that markets evolve. They change. A strategy that's been effective for the past 6 months might still be perfectly valid, even if it failed miserably for the 5 years preceding that, may be due to a change in market regime. And conversely, a strategy that recently stopped working could make a comeback later. What truly matters is understanding when and why a strategy performs and whether its underlying edge, the reason it works, is still relevant now. This makes sub-period analysis so, breaking your long backtest into smaller, distinct timeframes and equity curve visualization absolutely critical. You need to see if your strategy is performing consistently over time, or if its edge is maybe tied to specific market conditions that just may no longer exist.
Right, right. And this is where AI truly shines again, isn't it? It can become your ultimate assistant across the entire backtesting pipeline, not just a code generator. It sounds like an incredibly powerful ally in making sense of just vast amounts of data.
It absolutely is. Let's look at some concrete examples of how you can leverage AI throughout your workflow, beyond just the initial code. For data cleanup and pre-processing, which is a vital first step, often tedious, you can prompt AI with things like, clean this OHLCV dataset and remove rows with extreme outliers or nans. That's not a number of values. This alone saves hours of manual data scrubbing. Huge time saver. When it comes to feature engineering deriving new useful data points from your raw data, you can ask it to. Add a 21-period exponential moving average, an EMA, and a 14-period average true range ATR column to this data. Boom, it quickly generates common technical indicators for you. For strategy prototyping, like we discussed, you can simply describe your strategy in natural language. Buy when price crosses above the 20 EMA and RSI is below 40. Sell when RSI crosses above 70 or price hits the stop loss. AI can then swiftly turn that description into actionable, executable code. It's amazing for rapid prototyping.
Okay, and beyond just generating the code, how can it help with actually analyzing the results afterwards?
Right, so for performance reporting, AI can summarize your backtest results almost instantly. You can feed it a trade log, maybe from your Python script or even the ChatGPT simulation, and ask, generate win rate, average profit per trade, and drawdown from this trade log. This gives you quick, key performance indicators without manual calculation. Now, while AI might not be perfect yet at running massive, complex optimization loops entirely on its own without very careful guidance, it's excellent for helping with parameter sweeps, manually guided. It can generate the boilerplate code for you to tweak, allowing you to easily test different settings for your indicators or stop-loss values yourself. And when you inevitably get stuck, which happens, use it for debugging support. Paste your code snippet and ask, what might be going wrong here? Or, why am I seeing this error? It's surprisingly helpful. And finally, for documentation and comments, don't forget this. Ask AI to explain every line of code it generated for you. Or even better, ask it to add comments throughout the script. This transforms what might look like opaque code into something you can genuinely learn from and understand deeply.
So it's really not just a coding assistant. It's also acting as a truly powerful data analyst on your behalf. It can help a trader make sense of that raw market data in ways that, spreadsheets alone simply can't, unveiling insights you might otherwise completely miss.
Indeed. If you feed it raw market data like your OHLCV data or maybe trade logs, AI can help you understand it much, much faster. For instance, to identify price structure and regimes, you could ask, can you try to segment this data into trending and ranging periods based on volatility or moving average slope? It can attempt that analysis. To spot anomalies or bad data, a crucial step you can prompt. Find any suspicious price spikes or zero volume candles in this CSV file. This is absolutely vital for cleaning your data before running sensitive backtest, preventing totally erroneous results from bad data points. It can also suggest features for modeling. If you feed it a data set and ask, what other columns could I derive from this data to potentially use as inputs for a trading model? AI might suggest things like momentum indicators, different volatility metrics, volume spike flags, or even flags for specific candle patterns it recognizes. You can ask it to run quick exploratory data analysis, EDA. Just ask for things like histograms of returns, heat maps showing correlation between your indicators, or maybe autocorrelation plots to see if past moves predict future ones. It's also great for time-based filtering suggestions. You could ask it to help isolate data from the first 30 minutes of the session, or maybe only high volatility hours using the timestamps in your data. And finally, you can ask it to try and explain relationships it sees within the data. For example, what can you infer about price movement when RSI is above 70 and volume is also increasing? Ah, good. Now, while its inferences aren't always statistically rigorous, this capability can spark really useful hypothesis generation. Ideas for new trading strategies you hadn't considered. It's like having a lightning-fast research assistant sitting right there with you.
Wow, so what does this all mean for you, the trader listening right now? I think the core message is really clear. Backtesting is perhaps the one area in trading where your effort truly pays off most quickly and directly. If you're serious about becoming a better, more consistent trader, you simply can't stop at just visual confirmations on a chart anymore. It's not enough. Code, whether it's your own carefully crafted lines or these powerful AI-assisted scripts we've been talking about, it will empower you to simulate, iterate, and improve your strategies far, far faster and with much greater objectivity than any manual method or spreadsheet ever could. It's a different league.
Yeah, and if we connect this to the bigger picture, embracing these powerful analytical tools fundamentally shifts your focus. It really does. You move beyond just finding some static strategy that you hope works forever to continuously refining and truly understanding your edge in these constantly evolving markets. Because they do evolve. That edge, as the Backtester's Edge piece really highlights so well, isn't something you simply discover prepackaged or buy off a shelf. It's something dynamic, something that is genuinely yours to build. You own it, you refine it.
And that's a powerful thought to take away. Really is. If you love this content and this deep dive, please make sure you click like on this video and subscribe to our channel for more. Until next time, keep exploring, keep learning, and keep building your edge.